You see a headline that says one of the world's biggest insurance companies just posted a solid profit boost. But, when you dig just one layer deeper, a totally different and way more interesting story pops up. So today, we're going to decode China Life's latest mid-year report and figure out what is really going on.
Okay, let's jump right into the big puzzle here. On one side, you have the headline number, right? The one that everyone sees. Net profit is up a pretty healthy 6.9%. Looks great. But then you look at the profit from their actual day-to-day business, before taxes and all that, and it's down 11.5%. So wait a minute, how does that even work?
So yeah, how is this even possible? And maybe more importantly, what does this weird contradiction really tell us about the financial health of this absolute giant? Well, the answer reveals a much, much bigger story about strategy, about risk, and about where this company is headed. And that's exactly what we're going to unpack.
To get our heads around this, you've got to look at two competing stories that are pulling in completely opposite directions. So first up, let's look at the bull case, the optimistic view. This whole story is about a massive company making a really smart and so far very successful pivot in its strategy.
For anyone who's bullish on the company, it all boils down to this one number, a huge 20.3% jump in what's called new business value, or NBV. I mean, for a company this big, that is a massive move. It's probably the single most important number for understanding their long-term health.
So what the heck is NBV? Well, think of it like this. It's not about how many policies they sell today. It's about the total profit they expect to make over the entire lifetime of those new policies. So it's a measure of the quality of their growth, not just the quantity.
And here is the really crucial point. The company is actually collecting less cash up front from new policies. That's down almost 17%, but they're on track to make more future profit from the policies they are selling. They are deliberately choosing value over sheer volume, and honestly, it's working brilliantly.
Now, a huge part of this success came from completely shaking up how they sell their products. Their traditional army of agents was under pressure, right? So they turned their partnerships with banks into an absolute powerhouse. I mean, just look at this. A staggering 111% growth in new premiums coming through the bank channel. That's a powerful second engine for growth. And you can bet China Life's management is feeling pretty good about it. They're calling it an excellent result in a tough market. So from their point of view, this whole strategic pivot is a massive success. And that's the bull case, a smarter, more profitable, and more diversified company.
Okay. But that still doesn't solve our profit puzzle from the beginning. And to do that, we have to flip the coin and look at the other side of the story. This is the bear case, the pessimistic view, and it's where we start to see some cracks in the armor.
And here it is. This is where we solve the mystery. This is exactly how that 6.9% profit growth was created. Step 1, their actual profit from the business fell by 11.5%. Step 2, a massive tax credit gets applied, causing their tax bill to plummet by an incredible 95%. And then, Step 3, that tax credit was so big, it single-handedly dragged the final number back up into positive territory. So let's be crystal clear here. The profit growth that made all the headlines, it didn't come from selling more valuable insurance or from making brilliant investments. It's a one-off accounting effect. And for any investor looking for sustainable, repeatable earnings, that's a major red flag, because it's masking a real decline in the core business's profitability. The next crack we see is in the company's financial safety cushion. Their solvency ratio, which is a really key measure of financial strength, has dropped quite a bit in just 6 months. We're talking from nearly 208% all the way down to just under 191%. So what is the solvency ratio? Basically, it's a test of an insurer's ability to pay out all its claims, even in a total worst-case scenario. Now, to be fair, their current level is still way above what regulators require, so there's no immediate danger here. But a drop that fast is concerning because it could limit their flexibility to invest, to grow, or even to pay dividends down the road.
And this right here, this is the big storm they're sailing into. Their total investment yield was just 3.29%. In a world where interest rates are stubbornly low, it is incredibly hard for insurance companies, who are managing trillions of dollars, to find safe places to park that money and earn a decent return. This pressure, sometimes called asset scarcity, is a massive challenge for the whole industry.
So what do we have? We have these two powerful competing stories. On one hand, a really smart internal strategy that's clearly paying off. But on the other hand, we have these external pressures and some accounting quirks that are really clouding the picture. Let's put them side by side and see what it looks like when it all comes together.
This really lays out the central conflict, doesn't it? In the left corner, you've got the bull case, fantastic new business value growth, a successful pivot to new sales channels, higher profit margins, all of it driven by smart moves they're making inside the company. And in the right corner, you've got the bear case, a drop in core profit that's being hidden by accounting, a shrinking financial cushion, and that really tough, low-yield investment world, all powerful headwinds blowing from the outside.
So, who wins? The brilliant internal strategy or the tough external pressures? Well, instead of giving you a single prediction, the whole point of this explainer is to give you the key things to watch. That way, you can follow the story and judge for yourself as it all unfolds.
So here they are, the 4 things that are going to tell the future story. First, new business value. Was that 20% jump a one-time thing, or can they keep that high-quality growth going? Second, the solvency ratio. Does that drop level off, or does the cushion keep getting smaller? Third, investment yield. Can they find a way to squeeze out better returns in this tough environment? And finally, agent productivity. Now that their sales team is stable, can they make each agent more effective? The answers to these questions will show you where this is all truly headed.
And that brings us to the final critical question that this entire report really leaves us with. It all boils down to this. Is a brilliant internal strategy enough to win the race against a really challenging economy? The answer is not just going to define the future of China Life, it's a key question for so many huge companies all around the world right now. Definitely something to think about.